Canada's Big Six banks just released their 2025 Q2 earnings. Who are the winners? Who are the losers? And, well, who raised their dividend? Fasten your seatbelts, folks. This is going to be a good one. Canada's Big Six banks have entered Q2 2025 facing one of the most difficult macro environments in over a decade. They've weathered economic uncertainty before, but rarely have they been hit with this kind of one-two punch, a full-force mortgage renewal wave and, well, a hostile external trade environment courtesy of Donald Trump and that trade war he started. In this quarter, it is no longer an on the horizon scenario, but it is a here. And initial impacts have already hit. Well, that makes me wonder, are the banks ready? We will of course begin with that mortgage renewal wave. That has, well, it has fully arrived. Thousands of Canadians are now renewing sub 2% and 3% mortgages at rates well over, and that's right, well over 5%. As expected, with the jump in monthly mortgage payments, the banks have reported upticks in early stage delinquencies. However, the worst, and this is a good thing, the worst case scenario hasn't materialized. That's in part thanks to some of the banks getting ahead of the wave with some moves like blended rate renewals, extended amortizations, and aggressive loan loss provisioning. That does sound great, but keep in mind, there are signs that the stress on the banks is growing. Arrears are trending up, particularly in suburban and exurban markets, where many borrowers stretched their budgets big time to buy during that pandemic boom. Banks are watching this space closely, and the pressure will only build as more renewals hit in the back half of the year. If that mortgage renewal wave was not enough, we then have, well, number two, our second punch. We have that US tariff shock beginning to take effect. Banks are not, well, they're not technically a direct target of tariffs, but they can take quite the indirect hit for sure. Export heavy sectors are already feeling the pinch, particularly manufacturing and materials. And the ripple effect is spreading. Business loan delinquencies remain low, but credit quality is weakening in several regions. Some banks flag this in their forward guidance with more cautious outlooks on commercial lending. A sub to the channel is the proactive way to prepare for future content. In just a moment, we will look at the main highlights of those Q2 earnings. Overall, the banks had a mixed quarter. Some of them exceeded expectations, and some of them did miss the mark. So, who came out on top? Did any of them raise their dividends this time around? Well, we're about to find out. So, without any further ado, let's let's do this. We will start with a Scotiabank, and they've got a ticker of BNS. So, when it comes to their earnings, they were expected to come in at $1.55 a share. They came in at $1.52 a share. So they did miss those expectations by 1.94%. In terms of revenue, they were expected to come in at 9.06 billion. They did better. They came in at 9.10 billion. So they did exceed those expectations by 0.41%. But that miss on earnings is a fail. But on the bright side, the stock, well, their stock did recover and made positive strides after the report. In terms of their dividend, their yield right now currently sitting at 5.904%. That's $1.10 per share, and that is up. So they boosted their dividend by 4 cents. Scotiabank has been very stingy on dividend raises, and this boost is their first in about 2 years. They are projected to grow their earnings by 11.99% per year over the next 5 years. Now, their current price is sitting at $73.43 using a discounted cash flow model. We do get a fair value of $130.88. That of course means they're undervalued by 43.9% on their 1 year forecast. They are anticipated to hit $77.33. So that's actually an increase of 11.21%. That's not too shabby if you ask me for sure. In the quarter, Scotiabank reported that delinquencies remain stable and deposits are rising. Mortgage growth and consumer spending are, well, as expected, slowing, reflecting that growing caution among borrowers. They may have missed earnings, but they had enough confidence to raise their dividend and this is kind of great, I like this, to announce some share buybacks of up to 20 million shares. Next, we're going to take a look at Royal Bank. They get a ticker of RY. Their earnings were expected to come in at $3.18. They reported $3.12, so they did miss their earnings by 1.90%. In terms of revenue, they were expected to come in at 15.82 billion. Yeah, they missed that too. They came in at 15.67 billion. So they missed that by 0.96%. So they absolutely get an overall fail. Overall fail. I can't give them anything. Looking at their dividend, their yield is coming in at 3.541%, and that's $1.54 per share. So they did raise their dividend by 6 cents. This is the biggest increase among the big six this quarter. When it comes to earnings, they are expected to grow by 3.87% per year. In terms of their fair value, their current price sitting at $173.94. And with a discounted cash flow model, we do get a fair value of 262.91. It paints them as undervalued by 33.8%. 1 year forecast by the analysts on this one is $186.33. So that is an increase of 7.13%. Royal Bank did experience an 11% year-over-year revenue jump, which, that part is good for sure. Kind of their silver lining. Now, in addition to that, they did increase their loan loss provisions in response to economic uncertainty, as well as to cover impaired loans they inherited in their HSBC integration. So in case you are not familiar with impaired loans, they are simply loans that you are not expected to recover the full amount. So they are basically very high risk. Okay, let's move on and take a look at TD Bank. So when it comes to their earnings, they were expected to come in at $1.79 per share. They crushed it, $1.97 per share. That's they ended up exceeding that by 10.22%. Holy banana bread! Those are good numbers to see for TD. And lately they can certainly use that, absolutely. Looking at their revenue, they were expected to come in at 13.45 billion. They did beat that as well. They came in at 13.72 billion. So that's exceeding those expectations by 2%. They get a solid overall pass for sure. Now, when it comes to their dividend, there were no changes. So their yield is sitting at 4.432%, $1.05 per share, quarterly dividend, of course. Looking at their earnings. Now, their earnings are anticipated to decline by $6.80 per year over the next 5 years. Yes, I did say decline. Don't get too worried about that, though. They are currently looking at restructuring, and that, of course, costs a good amount of money. And they'll also have to divert some of those earnings into their planned remediation efforts. That's all part of that money laundering settlement. So we know where that money's going. It's not because they're doing badly. It's because they're paying the piper. Currently, their price, $94.77. So with a discounted cash flow model, we do get a fair value of $150.52. That does paint them as being undervalued by 7%. Now, their 1 year forecast, they're expected to grow to $97.20. So that is an increase, not that huge, 2.56%. TD did announce that they are cutting their workforce by 2%. And that's all part of that restructure that is, it's promised to cut costs in the future. Provisions for credit losses did rise, but they were actually lower than anticipated. Their earnings this quarter did receive a shot in the arm thanks to their sale of their, they sold their stake in Charles Schwab. Up next, we have the Canadian Imperial Bank of Commerce, ticker CM. They were anticipated to come in with earnings of $1.88 per share. They did beat that. They came in at $2.05 per share. So that, they exceeded by 8.90%. That's not too shabby either. When it comes to revenue, they were expected to come in at $6.95 billion. They reported $7.02 billion. So they exceeded expectations once again, 0.99%. Obviously, another overall pass. Looking at their dividend also did not change. So their yield is sitting at 4.153%, a dividend of 97 cents per share. Their earnings are expected to grow by 8.4% per year, which is not too shabby. Looking at their fair value, their current price, of course, $93.43. Using a discounted cash flow model, we get a fair value of $167.41. That does paint them as being undervalued by 44.2%. And that analyst 1 year forecast, that's coming in at $99.01. So that's an increase of 5.98%. CIBC had a good quarter with a nice jump in revenue. They also added more money for loan losses, though, like TD, they didn't add as much as expected. Hopefully that does not come back to bite them in the butt. They are also looking forward to they got a CEO change coming up here in October. All right, let's move to the Bank of Montreal. That's a ticker BMO. When it comes to earnings, they were expected to come in at $2.53. They beat that. They came in at $2.62. So they exceeded by 3.46%. On the revenue scale, they were expected to come in at 8.73 billion. On the revenue front, they were expected to come in at 8.73 billion. They came in at 8.68 billion. So they did miss by 0.58%. We'll give them a small P pass as they did just miss on revenue. Looking at their dividend, their current yield, 4.424%. That is $1.63 per share. Does that seem higher? It should, because they did raise that dividend by 0.04 cents. When it comes to their earnings, they're anticipated to grow by 6.69% per year. So their current price, once again, it's $147.37. Discounted cash flow model, we get a fair value, $215.07. So that does paint them as being undervalued by 31.5%. On that 1 year forecast, they are predicted to hit $153.53. So if they pull that off, that is an increase of 4.18%. In the past, BMO has had some trouble keeping their loan losses within expectations. And despite doing well in the first quarter, they did set aside more money than anticipated for loan losses. They, of course, they did this as well. They acknowledged the trend of rising risks in Canadian commercial banking. So they're covering their butts for sure. All right, finally, we've got National Bank, a ticker of NA. They were anticipated to come in at $2.40 per share. And well, with those earnings, they came in at $2.85. So they exceeded by 18.65%. Oh boy, that's not too shabby at all. Looking at their revenue, they were expected to come in at 3.30 billion, and well, they came in at 3.65 billion. Once again, holy banana bread. They exceeded by 10.73%. They very easily get an overall pass. I guess we'll call it the capital P pass. They get that today. Looking at their dividend, that's coming in with a yield of 3.494%. Quarterly dividend, $1.18 per share. And yep, it sure did increase by 4 cents. When it comes to those earnings, they are expected to grow by 1.4% per year. That does seem a little low. I think they're going to outdo that. On to their fair value, their current price, $135.07. And using a discounted cash flow model, that fair value comes in at $213.40. Once again, undervalued, 36.7%. The 1 year forecast for these guys, $139.08. So that is a 2.97% increase. National Bank had a very strong quarter for sure. They did continue, of course, to add to their loan loss provisioning. In addition, they did state that they are in a good position despite the geopolitical and geoeconomical currents to continue to support business growth. All right, let's take a look at that big picture. So looking at their returns for the last year, we've got this cool graphic here showing them all in comparison to their share values. However, as you guys know, I do like to add in the dividend. So let's look at those total returns. This time around, coming in at number 6, we got the Bank of Nova Scotia with 20.86% total return, and that's not bad for number 6. Number 5, Royal Bank, 22.04%. Number 4, BMO, 27.05%. And National Bank coming in at number 3 at 30.15%. Now, this one was a bit of a surprise. TD coming in second place, 32.20%. They have really picked themselves up since the last time we did this. And at number 1, they seem to be unbeatable. CIBC coming in at 43.38%. As of course a bonus, let's take a quick peek at a few of those smaller banks and see just where they come in with their 1-year total returns. This time around, they kind of switched places. So we've got EQ Bank coming in at 8.90%, and Laurentian Bank, look at them, 28.03%. They had a good quarter for sure. I certainly love it. I'm kind of thinking I might want to do a little more with these two banks. You'll have to check out next quarter. Let's see what that thinking leads to. So we of course are going to do this all over again after the next quarter, and we'll see if the banks. We're going to see if they can keep up their resilience as some of those negative catalysts, well, they're going to continue to build for sure. As usual, if you are interested in any of these bank stocks today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on the bank ETF. Thank you for watching, and I will see you in the next video.